Hello and welcome to another video. Today we're going to talk about what could be touted as the single best investment ever. This investment is the investment which Warren Buffett said that he would make if he wasn't Warren Buffett, and how he wants to invest his money once he's dead. So what is this investment? This investment is the humble ETF. Before we get started with the video, make sure you hit that like button and smash that subscribe button so that you don't miss out on any further videos. Firstly, what is an ETF? Well, an ETF stands for an Exchange Traded Funds, and this is a fund which is traded like a stock on a stock market and provides buy and sell prices up to the minute. These ETFs normally cover a whole index such as the FTSE 100 or the S&P 500. And this is why they're often called index funds. ETFs can also be used to track a specific sector. There can be ETFs such as technology ETFs or healthcare ETFs, which track specific companies that are bound together by that specific sector, meaning that you can invest in a whole sector if you prefer them rather than just a whole index. ETFs are incredibly popular investment tools, so popular in fact they represent 25% of the total daily traded volume on every stock market in the world, making them perfect for professional investors and individuals alike. However, this hasn't always been the case. ETFs haven't quite been as popular as they are today. Despite being around since the early 1990s, they only really took off after the great financial crisis in 2008, as investors understood the benefits of ETFs over managed funds. After the financial crisis in 2008, many investors realized that they had just paid huge fees to investment managers who had just lost them loads of money. However, ETFs provided a cheap and easy way to provide a diversified portfolio, and these low fees are one of the key benefits of an ETF. Numerous studies show that actively managed funds by professional investors tend to underperform the market after fees. Among 4,600 US funds which cover stocks, bonds and real estate, and have a combined assets under management of $12.8 trillion. Only 24% beat passive alternatives over the 10-year period, the end of 2018. And in simple terms, what does this mean? It means that when you're paying a professional investment manager to manage your money, they're normally taking two fees. First fee is a management fee, which is normally up to 2% of the amount of money that you give them to invest. And then is an outperformance fee, which is 20% of the outperformance. As you can see, when there's underperformance of the market, this can start to really hurt you and means that you are getting less value for your money. ETFs charge tiny fees in comparison, normally a fraction of a percent. This is because they don't need all the analysts and employees that an actively managed fund does. This is because they track an index, or they track a group of companies normally weighted by the proportional value of those companies. Another key benefit of the ETFs is diversification. As you're normally buying an index, you're buying exposure to many companies in one go. In theory, this is to protect investors should one share of one company go down. Because you're buying the whole index, you are affected by the price of many different companies. For example, if you buy an ETF for the FTSE 100, you are exposed to the 100 largest companies that are listed at the London Stock Exchange. This means that ETFs are great for people who are beginners or just aren't that interested in reading financial statements, understanding the financial news, understanding why an event on the other side of the world has impacted their portfolio. This is a perfect way to buy a share in an ETF, get exposure to many companies, and then just sit back, relax, and get on with your life. Whilst ETFs are great and the benefits far outweigh the negatives, it is worth understanding what these negatives are so you can understand if ETFs are a good investment for you. Probably the biggest reason that investors don't like ETFs is the lack of control. As you're buying a whole index of companies, you're not choosing which companies you necessarily prefer, as some investors may prefer to buy more stock in one company and less in another. However, you're not able to do that when you invest in an ETF. And whilst you can't adjust on how much of a specific company that you own, sometimes you can actually get overexposed to certain companies. Because many ETFs are weighted by the value of the company, that means that multiple ETFs that contain the same valuable companies mean that you will have a greater percentage of your holdings in a certain company. For example, Apple is the largest company in the world, and if you buy a technology ETF or a ETF that's specific to American companies, it will be weighted really highly. However, you may not want so much exposure to Apple, because if Apple has a bad day in the stock market, you can lose a significant portion of your net wealth. Also, the choice of ETFs can be overwhelming. As there are thousands of companies which you can invest in, there are thousands of different ways of slicing up those companies to be put together into groups of other funds of companies, such as ETFs. There are currently 5,000 ETFs in the world, which means that you can be overwhelmed as an investor to truly understand what companies are in an ETF and should you invest in one ETF rather than another ETF. To make matters even worse, there are multiple companies that provide ETFs such as Vanguard and iShare, which can slightly change how they provide virtually the same ETF. To wrap up, for the ease and accessibility, exchange traded funds are perfect for beginners. They're also perfect for many people who just frankly aren't that interested in reading financial statements and being up to date on the financial news multiple times a day. They provide great exposure to the largest companies in the world. The incredibly low fees and the fact that ETFs generally outperform active managers shows why ETFs are so popular and why they're going to continue to grow and be the home for the vast majority of investors' money. I hope this video has been useful and has provided a good introduction to exchange traded funds, what they are and how they work. If you have used exchange traded funds before, please let me know in the comments below on how you've got on and what you think of them. And before you leave, make sure you like this video and hit the subscribe button, and I'll see you next time.